Hello everyone, hope you're all well. Just to introduce myself, my name is Paul Taylor. I work as an advisor at Nistad, but over the last almost 38 years, I've been a senior advisor, chair, non-executive and change manager across most areas of financial services, in particular asset and wealth management. Worked on primarily change management type projects, but I've also done a lot of advice on product setup, regulatory compliance, and various other items. And finally, I'm a published author, speaker, and a lecturer at the Open University.
Oh,
I hope that.
yes, thank you so much, Paul, for being here today. So, with the topic today, would you like to tell us what you're going to be talking about today?
Yeah, I'm going to talk about private markets. There's quite a lot of noise in the market, double pun there, about private markets. Some of it is very accurate, some of it is misleading, and some of it is almost like fake news, to quote a very famous person at the moment. So hopefully, Maggie, when we go through the various questions and everything, we should be able to maybe clear some of the fog, and hopefully by the end of this chat, people have more detail about what actually is in private markets and why an investor would or would not, as the case may be, investigate them or invest in them.
Okay, perfect. So, what are private markets?
Yeah, there's two types of markets. Obviously, you get the private markets and you've got your public markets. So if you look at public first, which is your traditional stock shares, bonds that are traded on public exchanges, on like the New York Stock Exchange and Nasdaq, they're quite well known. But where private markets are any investments that are not traded on these exchanges, and they're often traded on a point-to-point basis with whoever's issuing the various shares. And the methods could be anything like private equity, venture capital, private credit, which is like a private loan. It could even be real estate. It could be infrastructure, like funding a new bridge in France or something, as well as things like alternatives in some cases, which could be anything from uh, um, owning the back catalogue of Michael Jackson's records to owning very, very expensive cars. But to provide a little bit more detail, there's probably 7 main differences. The first one is how easy one can access private markets. As I said before, public markets can be accessed quite easily. Anybody with access to one of the wealth platforms that are dotted around the world, you can access them and you can get them quite quickly. Where private markets are really only limited to institutional investors or very, very rich people. That's because they're quite complex investments sometimes, and they need a high minimum access amount of money to get in. Also, private markets liquidity, which is the ability to buy, sell, convert to cash, it can be very, very slow. Because of the nature of these private markets, money could be locked up for long, long periods of time. In fact, I've worked on private market investments that have been locked up for 10 years. So what that basically means, if you put your money in now, you won't be able to get it back to 2036, which is not always a good thing if you might need the money earlier. Also, because of their sort of more private nature, it's actually very hard to get a price for a private market. They're often done very periodically. For example, if you're trying to value a back catalogue of a pop artist, you may only do the valuation once a year. So basically, you don't always really know how much it's worth or how much it's not worth. Private markets are also are lighter regulated with very limited public disclosure. If you compare that to a public market, like a big FTSE firm or a big New York Stock Exchange firm, who will then issue public reports and accounts very frequently, private markets you may not get anything for years on end. So obviously, there's a risk there. But this obviously means that private markets obviously have a higher individual risk on each individual one. The sort of sixth main difference is around return potential. What you tend to find is that private markets have a potential for higher returns. And you would hope that if you're tying your money up for 10 years or 5 years or even a year, you want to try and get a higher return. And then if the fact you can buy in and buy out and liquidate within 24 hours. But the challenge there is why in potential you should get higher returns. the actual rates of return do vary by individual manager. So some managers are good and some managers are bad. And the final thing here is, again, just almost repeat what I said earlier on, is that public markets we have a very flexible time horizon to invest in. You can buy and sell, almost within the same day if you wanted. I'm not too sure why you would, but you could. But you said before, with private markets, you need a long-term commitment. As I said before, it's a very long-term commitment, and capital could be tied up for many, many years. I hope that okay, Maggie.
That clarifies it. Yeah. So why are investors turning to the private markets then?
Yeah, I mean, it's probably best if you look at investors in two buckets or two groups. The first one is your institutional investors, which are your large pension funds, insurance funds, asset owners, sovereign wealth funds. And the second group is individual investors, high net worth investors, people like me and you who just happen to have a spare £50 million that they don't know what to do with. So going back to the first group, which is institutions, pensions, endowments, large asset owners, insurance firms, they are a lot of these investments are very, 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 very long-term investments. I mean, I worked for two large investment funds in the UK, and they were looking for returns over 10, 15 years. So having your assets tied up for this long-term period is actually very, very good, because obviously you're focusing on 10 years down the time. And obviously, based on this, as I mentioned earlier, that you should be able to get a higher return because all your assets are tied up. They're very into what they call a liquidity premium, i.e. the longer it's tied up, the better returns you can get. Also, because of these large investors, they want very much wide diversification. Obviously, you can diversify in public markets by different stocks and shares and bonds and cash. But if you sort of invest in if you invest in private markets, you can also get much more diversification, because as well as normal stocks and shares, you can invest in a bridge, or you can invest in a shopping centre or a housing estate, or in a pop band or something along those lines. Also, the other areas I mentioned before, that's institutions, but looking at your more individual high net worth investors, who people like you and me, who have a spare £100 million in their bank pocket, we don't know what to do with it. Similar is actually in a strange way. A lot of these individuals are looking for higher returns, which obviously go past the normal public markets. They may want access to early stage or private companies. If you get in earlier, you should be able to hopefully get more investments in. They also have a belief in active management over passive investing, which obviously is quite keen in public markets. And also, finally, it's portfolio diversification as well. So there's quite a lot of overlap, but I just think the key thing is often the institutions tend to have a longer view, where individuals would want diversifications on returns.
Okay. So the next question I would have is, what are the drawbacks and challenges of private markets then?
Yeah, of course. I mean, I've covered a few of them, but I'll just summarize for the purpose of the question. Is probably about 8 or 9. The first one is the private markets are very illiquid. As I mentioned before, it's hard to buy and sell. So you need to be prepared to tie your money up for 5, 10, 15 years. You can exit early, but you often have to pay like a penalty fee. So you only exit early if you really need the money. Otherwise, you're going to get absolutely ripped off with a high fee. Often in initial investments, you have to put in a very high, like if you go onto a normal platform to buy public markets, you can invest a couple of £100, £200. If you want to invest in a private market, you may have to invest in, you could be hundreds of thousands, 200, 300, up to £1 million bare minimum even to turn up. There's
Okay.
lacks of transparency. You don't really know what's happening sometimes in these private assets you're investing in. The fees tend to be higher. There's a long time to get your gains, which obviously ties into the illiquid, keeping the assets tied up for a long time. And also the other thing is, the other two things is, sometimes the private market structures are very, very complicated. On the public side, you've got UCITS and all these very good regulations to control things. But if you're invested in private markets, you might have very bespoke arrangements with a manager, which can actually get very complicated, and normally to the benefit of the manager is no one else. And last, but probably the most important, is private markets don't have much real heavy regulation around them. So you really need to know what you're doing before you're going into them, which conversely, against public markets, i.e. normal stocks and shares, there's lots of governance around them. So you feel a little bit, even if you're a little bit unsure what's going on, you feel like you've got a little bit of protection around you.
Yeah. So how can managers and investors mitigate these challenges then?
Yeah, I think the rules for mitigating the best practice or hints and tips to mitigate private markets is probably not that much different for as in public markets as well. I mean, first one is the key one is always have diversification. Have multiple strategies, have multiple managers. Uh, Make sure the managers you do select are good. I mean, don't just pick the first one that you find. Do your due diligence, ask around, speak to people. Make sure any investments you go to in the private world, you do your due diligence as well. Don't because it happens to be at the top of the tree or the top of the table or some sort of performance table doesn't mean it's always going to be there. To double check everything.
Okay.
When you do your investments, the key thing there is to try and invest I would call it in phases. I think the business call it staggered. So basically, you don't invest all your money at once. Maybe invest in several private investments as well as over a period of time. Make sure you get good fees and really understand the fee structure because when these structures are set up, they're made to make sure that everybody makes money, but you want to make sure that if the markets go down or prices go down or other problems, you're not paying excess fees.
Okay.
And the other one is always maintain some sort of liquidity, i.e. cash. Because bearing in mind, as I said before, the investments get tied up for many years, 5, 10, 15 years. If you do need money, make sure you got some money as well. So, which is not actually that much dissimilar to investing in normal public markets, but obviously the longevity and of private markets does cause a challenge.
Okay. So therefore, what do you feel is the long-term outlook then?
I think it's positive. I think, I mean, I noticed there were some challenges I mentioned earlier, but they're more like facts of life, I suppose, than problems, if you know what I mean. So
Yeah.
I think private markets will continue to grow. I think, particularly on the institutional side, pensions, sovereign wealth funds, insurance companies, asset owners, they will put more money in because obviously they've got a very long-term investment horizon. I think they'll also become more mainstream. I think that basically means that products will be available for you more retail investors. Obviously, you have to note the issues about private assets and lack of liquidity of those. Managers will become more niche focused on that. So I think that's good. I think fee pressure will increase, i.e. downward pressure. The more people investing, the more managers, the more chance are that fees will go down. I think the transparency and governance and regulations will have to improve because people just don't like investing in stuff they don't feel protected. And I think
Yeah.
that is often a good thing. And I think the final thing with any private markets, because of the long-term returns, people need to take a long-term mindset to think, I will not get any returns from this potentially, say, for 5 to 10, 15 years. I might actually seem to lose money in those periods until we get to the end. So it's a real case of saying, I'm not going to make £1 million overnight. I might make £5 million over 5 years. I think
Okay.
the outlook is good.
Yeah. Well, thank you so much for Paul for this discussion.
No, it's lovely. I'm glad to contribute as always.